If you've been to the grocery store lately, filled up your gas tank, or tried to buy literally anything, you've probably noticed something. Everything seems more expensive than it used to be, and you've probably heard people blaming inflation for it. But here's the thing. Most people use the word inflation without really understanding what it means or how it actually affects their money. And that lack of understanding, it can cost you thousands of dollars over your lifetime. So today, we're breaking down inflation in a way that actually makes sense. By the end of this video, you'll understand what inflation really is, what causes it, and most importantly, what you can do to protect your money from losing value. All right, let's start with the basics. What exactly is inflation? In the simplest terms, inflation is when the general level of prices for goods and services rises over time. But here's the key part that people miss. It's not just that things cost more, it's that your money buys less. Think of it this way. Imagine you have a $100 bill in your wallet. In 1990, that $100 could buy you about 15 movie tickets. Today, you'd be lucky to get 5 or 6 tickets for that same $100. The paper in your wallet didn't change, but what it can buy did. That's inflation. The official definition from economists is a sustained increase in the general price level of goods and services in an economy over a period of time. When inflation happens, each unit of currency, each dollar, purchases fewer goods and services. So, while your salary might be the same number of dollars, if inflation is happening, those dollars don't go as far. Now, here's something most people don't realize. A little bit of inflation is actually normal and even considered healthy for an economy. Central banks like the Federal Reserve actually target about 2% inflation per year. We'll talk about why in a minute. So, how do economists actually measure inflation? You can't just look at one item and say, yep, that's inflation. They use something called the Consumer Price Index, or CPI. Think of the CPI as a giant shopping basket filled with all the things an average household buys. We're talking groceries, rent, gasoline, clothing, medical care, entertainment, everything. The government tracks the prices of all these items over time. Every month they check, how much did this basket cost compared to last month? Compared to last year, like that percentage change is what we call the inflation rate. For example, if the CPI shows a 3% increase over the past year, that means on average, things that cost you $100 last year now cost you $103. Now, here's something important to understand. Your personal inflation might be different from the official number. If you're a student who doesn't own a car, gas prices don't affect you much. But if you're commuting 50 miles a day, gas prices hit you hard. That's why inflation feels different to different people. There are also other measures like the Producer Price Index and core inflation, but CPI is the one you'll hear about most in the news. Okay, so we know what inflation is and how it's measured, but what actually causes it? This is where it gets interesting because there are actually several different causes. Because number one is demand pull inflation. This happens when there's too much money chasing too few goods. Imagine a concert with only 100 tickets, but 500 people want to go. Prices go up, right? Same principle. When demand for goods and services exceeds supply, prices rise. This often happens when the economy is doing really well and people have more money to spend. Because number two is cost push inflation. This is when the cost to produce things go up, and businesses pass those costs to consumers. Think about the COVID pandemic. Supply chains got disrupted, shipping costs skyrocketed, and suddenly everything got more expensive because it was more expensive to make and transport. Because number three is built-in inflation. This is sometimes called the wage price spiral. When workers expect prices to rise, they demand higher wages. When businesses pay higher wages, they charge more for their products, which leads to workers demanding higher wages again. You see the cycle? Because number four is money supply. Here's the big one that gets controversial. When governments print more money or central banks keep interest rates super low, there's more money in circulation. More money chasing the same amount of goods? Prices go up. This is basic supply and demand applied to money itself. An extreme example, Zimbabwe in the 2000s printed so much money that they had trillion-dollar bills, and a loaf of bread cost billions. That's hyperinflation, which is inflation completely out of control. Now, let's talk about what this means for you and your hard-earned money. Here's the brutal truth. Because of inflation, your money is quietly losing value every single day you keep it in cash. Let's do some math. If you have $10,000 sitting in a regular savings account, earning basically no interest, and inflation is running at 3% per year, after 1 year, the purchasing power of that money has dropped to about $9,700. After 10 years, it's worth about $7,400 in today's dollars. You didn't spend a dime, but you lost over $2,500 in purchasing power just by leaving it sitting there. This is especially brutal for retirement planning. If you need $50,000 a year to live comfortably today, in 30 years with 3% average inflation, you'd need about $121,000 a year to maintain the same lifestyle. That's more than double. This is why inflation is sometimes called the silent thief. It's quietly stealing your purchasing power without you even noticing day to day. Okay, enough doom and gloom. Let's talk solutions. How do you actually protect your money from inflation? Strategy number one is invest in assets that outpace inflation. The stock market has historically returned about 7 to 10% per year on average, which beats the typical 2 to 3% inflation rate. Real estate also tends to appreciate and rents increase with inflation. The key is, your money needs to be working for you, earning returns that beat inflation. Strategy number two is Treasury inflation-protected securities. These are government bonds specifically designed to protect against inflation. The principal value adjusts with inflation, so your investment maintains its purchasing power. They're not exciting, but they're safe and effective. Strategy number three is increase your earning power. This is huge. If your income isn't keeping up with inflation, you're effectively taking a pay cut every year. Negotiate raises, develop new skills, switch jobs if needed. In many industries, the biggest raises come from changing employers. Strategy number four is be smart about debt. Here's a weird thing about inflation. It actually helps people with fixed rate debt. If you have a mortgage at 3% and inflation is 4%, you're essentially being paid to borrow money. The dollars you're paying back are worth less than the dollars you borrowed. Strategy number five is diversify. Don't put all your eggs in one basket. Stocks, bonds, real estate, maybe some commodities. Spreading your money across different asset classes helps protect you from any single thing going wrong. Let's say you have $20,000 to invest. You might put $10,000 in a diversified stock index fund, $5,000 in Treasury inflation-protected securities, $3,000 in a high-yield savings account for emergencies, and $2,000 in a Roth IRA. That's diversification. Strategy number six is keep learning. Economic conditions change. What works today might not work tomorrow. Stay informed, adjust your strategy, and don't be afraid to get professional advice if you're dealing with significant amounts of money. All right, let's wrap this up. Here's what we covered today. Inflation is the decrease in your money's purchasing power over time. It's measured by the CPI caused by various factors like demand, supply issues, and money printing. And most importantly, it's silently eroding your wealth if you're not actively protecting against it. The good news? Now that you understand how it works, you can take action. Invest wisely, diversify your assets, increase your income, and stay informed. Remember, cash might feel safe, but during inflation, it's actually one of the riskiest places to keep your money long term. If you found this helpful, smash that like button and subscribe for more content on personal finance and economics made simple. Drop a comment below. And can you tell, what's the most noticeable price increase you've experienced lately?